Damn it, I was on mute. All right. Hey, welcome all. Good morning, good afternoon, depending on what, or maybe good evening. I don't know which time zone you guys are joining from. But good to be back here and welcome you all to our Saturday discussion on everything around investing. Just a quick tech check. Are you guys able to hear me? And you can see a Word document. Just confirm, please.
We can. Good morning, Vivek.
Morning. Okay, cool. All right. So what caught your eyes, guys? What's on your mind to discuss today? There are a lot of things that happened um, in this week. So anything new? The market was down, yeah, barely. Yeah, it was, but I don't think that too much. We had some
The
recovery.
top stocks were down, though. All the top stocks were down in the NASDAQ. The tech
Yeah,
stocks were down.
Nasdaq didn't recover. Nasdaq was a bit down, but we had some good swing on the very last day. Jerome Powell, he delivered. So we will talk about it. U.S. government invests in Intel. Yes.
I heard yesterday that Taiwan people or companies they own like 3 times Taiwan's GDP, which is $800 billion of Nvidia stock.
Maybe. I don't know where that information comes from.
Well, it comes from a friend, but
Okay.
you figure why hasn't quadrupled in like 3 years?
Possible, but I think that sounds to be too much. $800 billion means almost 20% of Nvidia shares are held by people in Taiwan. Maybe they are holding it through investments in some of the US funds. That's possible. Yeah, but I've not seen any credible source of information on this one. And undoubtedly it may be true, but we won't know. What else? US government invests in Intel. Yeah, my investing thesis on Intel was it's a strategically important, but I did not see this move coming from US government. But when our administration is talking about creating a sovereign wealth fund, then in that perspective, it's not a surprising move because there are a lot of sovereign wealth funds. US doesn't have one, but there are other countries who have sovereign wealth funds, and they do take positions in private companies or publicly listed companies. The biggest one is Norway, Norges Investment, and they have, I think, a couple of $1 trillion under investment, and they have a stake in a lot of big companies across the world. So, and that's one reason why the CEO or the chief investment officer does have no problem in calling the CEOs of the biggest companies on his podcast. So it's always good to listen to that guy and their podcast because very recently, he had Brian Moynihan. I'm like, how could every CEO will go and talk on his podcast because they are the biggest sovereign wealth fund in the world, right? So he exudes a lot of power, and when he calls the CEO, come and talk to him, they will oblige him. Powell inflation, while jobs posting is not great, we will talk about that as well. I don't think just the September cut made the whole difference, but little change in the tone, that was a huge difference. What else? So we had a big, I would say that macro level data change from Jackson Hole that changed the market. So what I did this week was what podcast? It's a call. Hold on, I'm just looking at my cell phone. It's hosted by the podcast name is In Good Company with Nikolai Tangent. Let me just type In Good Company, Nikolai Tangent. Yeah, so he's able to get the CEOs of the biggest companies on his podcast. So yeah, it's a good thing, if you are one of the I am a sucker for these podcasts. I think last year I went through all the list of all the podcasts that I listened to and my reasoning around why each one of those, what information I gleaned from them. So you guys know about it. So yeah, so Norges Bank is the biggest one. What else? Yeah, so I was talking about what I focused on this week. There was a memo from Howard Marks. He released his new memo for August. So whenever he releases a new memo, I would like to go on to always want to go and read through that. So that's what first thing I did was that. Also, I went through some of the earning transcripts. Like I told you, it's been pending for a few days. So I went through a lot of those earning transcripts. If you are following me on Twitter, I posted what I gleaned from some of those companies after reading through the transcripts of their earnings call. Also posted a little more themes on some information or that we could glean from looking at the fund managers' movements from the 13F filing. I was posting one every day. I just posted today morning, so I'll go through that. What else? Yes, and shareholder letters, Pershing Square shareholder letter, that as well. And I'm yet to finish the book. I recently had started on a new book from Nick Majuli, the book called The Wealth Ladder, and hopefully I'll be able to finish it in this coming week. Yeah, so that's what majority of the time spent, and of course time spent on trading and going through different companies and what else I see in the market. Right. Anything new at you guys' end? Oh, I see a question from Bilal, new to the group. So welcome, Bilal. Is this more of a discussion group? What's happening now? Education, option trading, or a mix? Jose has answered, yeah, it's a mix. Because what I realized was when I started the group 5 years ago, it was focused only on options. But then I realized that if you are a new investor, that's not how you should start investing, because then it becomes very restrictive. And I see a lot of people, I see on Twitter all the time, a lot of people just very new to investing and say, I discovered this new option selling stuff. It's great because I made 20% selling options this year. Guys, you only came into option selling in 2025 and you've been selling puts. Of course, you'll make it. Selling puts in a bull market, yeah, but you don't know what happens when the market will turn around. I've been around the block for many years, and then I said, you know what, we need to first focus on how to become a better investor, and options is just one of the tools, and you need to know when to use these tools at the right time and in a right way. So expand it beyond just options to basically focus on overall investing, us becoming a better and better investor. So if someone is looking to only discuss options, we'll probably have an opportunity of that when at the end of a session we'll break out in the breakout rooms, and one of the most popular breakout room is options trading. Folks will knock themselves off around talking about, reviewing the trades or looking at what is the hottest ticker in terms of a premium and all that stuff. So
Uh,
that's why my idea is I'm not married that I'm going to use only options. My end goal is how can I continue compound my portfolio? And if that means options or stocks, or in that case, even means investing in a bonds because the market may be going down, I'm open for it. So, what stocks did you buy or trade this week? I will cover it when I'll go to buys and sells for this week. That I'll talk every week. I'll tell you from transparency perspective. So we'll answer that question. All right. Looks like yes, that's good enough. We have what 30 people for now, and almost maybe we'll stay for 2 more minutes before I jump onto my agenda that I have on my plate. Any other questions? So what else I did? Yesterday I spent almost 4.5 hours on at a startup mix event. I think I talked about it earlier. Last Friday of every month. Sometimes it's on the third Friday or penultimate Friday. They have us. I basically go and participate as a judge in a startup pitching event. So we went through. It's fun and privilege to listen to founders on what they're building and have discussions with them, ask questions around business and everything else. So it's great. But only one common theme that I saw across all the founders is AI. I mean, that's the only thing that's working right now. Whether the solution is completely based on AI or it's a business model that have been around for years, and now we are using AI to make it more efficient. So I've been doing it for now 5 months. And we're looking at over what different kind of projects are coming up. All are AI. Satish, where did you go? Can we also attend? Yes, it's on a meetup. It's a hacker dojo. So basically, it's a non-profit organization. They conduct a lot of events. Almost, I guess, every day they have one or other event. Sometimes, Python meetup, Rust meetup, some other technical meetups and discussions. And I just attend the once in a month startup pitches and basically networking mix.
Is it in person or?
It's in person. The more important thing is that it is in person.
Oh, okay.
And that's why I'm more interested in it because, hey, we do a lot of Zoom stuff anyway, and investing is so individual and boring that it's fun to go and meet people in person. So I will just let me just. So this is the meetup group, Hacker Dojo, and I'm basically one of the judges for their startup pitch mixes. So if you look at this one.
Oh, okay. Thank you.
So generally we have around 80 to 100 people show up, and there are slot for 10 or sometimes 11 founders. They basically send their pitch decks in advance, which I spend time on, a few hours going through those pitch decks, and then go and attend it. But it's fun. Even if you're not founder, I mean, we just go and talk to people in industry.
Correct. Yeah.
All right. So let's get going with our today's session. And I also know, I think I met a couple of people over there who also attend our this Saturday meeting, which is also fun because at the end of the day, it's all about investing. Have you invested in any? Not. If I invest in the private companies, I only do through syndication. It's very difficult to move the needle. But I don't have that big a fund, right? It's my personal money, and I'm not that rich that I can invest, $1 million in one individual companies. So if you want to invest in any, the startup, you at least need to invest in at least 20, 30 to give yourself some chance for any success. The success rate is very low, 2%. What we hear in terms of, why a lot of individual investors get attracted toward angel investing is the stories are really big. The one becomes successful, we hear about that. So there's a lot of survivorship bias in this one, but we don't hear about other 98, those who didn't make it to the, basically had an exit. So I don't have a big fund in which I can put in like 30, 50 companies. So I basically do only through syndicate. All right, so let's get going with our today's session. Welcome everyone. This is our discussion number 289. Every Saturday morning to talk about investing. We cover stocks, bonds, IPOs, crypto. Now a little bit more on the private side, because now the private credit, private equity is gonna come into your portfolio. So we should be aware of what's happening on that world also. So anything that you can buy, trade on through US exchanges, I'm open for discussion on that one. That's what we focus on. Focus on how to become a better investor. And that means training ourselves, training our mindset is very, very important. At least that's what I have learned. Forget about all the technicals. Mindset is most important thing when it comes to investing. So I do spend a lot of time on that as well. So welcome you all. For this week, our stated agenda that I have is to go through Howard Marks memo. Of course, I'll start with the macro level, see what's happening in the equity market, give you brief on the crypto side. Then we'll look into the Howard Marks memo. And in conjunction with that, I also spent some time into expanding that memo and building on the InvestCon framework that Howard Marks had mentioned, and see what are the some market indicators that we can use. Then I'll also look into in continuation from our previous week. We'll look into a couple of super investors moves, and then we break out or network in the breakout rooms. That's for the agenda today. All right, as always, anything that we discuss here is only for education, entertainment, but not any sort of financial or tax or investment advice. So be responsible for what you do with your portfolio, okay? And talk to some professionals if you want to, if you need some help. All right, so first, I came across one tweet from someone says, I lost all my money because of Edwin Dorsey's report. Anyone know who this person is? Edwin Dorsey? I'm not interested in the individual person, but looks like whoever had posted this in Reddit, they went short on couple of three stocks, CUPR, UFG, FLYE, and these stocks went up 3x, 4x. It says, I would only invested 10% of my portfolio and I'm wiped out. So, and then what happens? When a portfolio gets wiped out, you tend to blame everyone else, right? So it's oh, I blame Dorsey's report for pushing me to do these trades. I also blame myself and blame the system that allows this to happen. Together, it has destroyed me, right? So who's to blame, guys? Who's to blame here? Is it Dorsey who's putting out these reports which he says short these stocks and these stocks become 5x, 6x, whatever? Or is it the system that allows you to short the stocks, whereas very clearly, if you short the stock, the loss could be infinite because stocks can continue to go up. And your gains are limited to the price at which you had short the stock. So why does the system allow you to do it? Or is it the market? I short the stock and market suddenly turned around. This is a crap company. It's got no revenue. The CEO is he's stealing money from the company. So there is no way this company, the stock will go down to zero, and the stock has become 5x. So anyway, she said very clearly, right? It's a buyer beware. You don't get to blame anyone, whoever's in Twitter, etc. You have to be caretaker of your own portfolio. Don't blame the system. Don't blame the market. Don't blame the person who told you to do this. It's you who made the decision to short the stock, and you have to be blamed. Plain and simple. Understand what you're getting into before you do any of these kinds of trades. Alan, can you discuss a little bit about track strategies when you have time? I'm not a CPA. Only tax strategy that I deploy is I look at what's my realized gains and how much do I want to have it, and just do tax loss harvesting, right? And I did talk about it, I think, in one of a previous session where I said I sold the stock. Not that I'm bearish on the stock, but that's my momentarily very tactical move to do the tax loss harvesting on that stock, because I had more gains than what I was anticipating, realized gains that what I was anticipating for this year. So I had to take some tax losses. But I can talk about something called direct indexing. I see a lot of fund managers or the not fund managers, but financial advisors talking about it. So that's one way. But let me take a note of tax strategies for summit. Mike, it's a free ability of the yappers in the system. Dorsey is to blame. I don't think there's Dorsey to blame. Again, I'm not of opinion. Ever since I became a little more active and trying to understand how the market works, I realized that it's only me to be blamed. Is there a way to find out if we are short the stock using options or stock? I don't know. I mean, this just came on Twitter, right? What the heck I did. My shorting strategy, butterfly option position. Even so, I time my short for quick entry and exit. Yeah, if you're using options to short it, and as long as you're not, it's a risk defined, you know that you cannot lose it in infinite. Hopefully, if you close your trade before the expiration. Some of the people, they just don't know what they're getting into. Nope. All right. Looking at the macro level. So remember last week we talked about Fed is thinking about to cut or not to cut, but eventually looks like Fed is going to cut. So we had a Jackson Hole meeting that happened this week, which is basically a congregation of all the Fed governors, basically the chair of Fed from different countries. You will see, from Japan, from EU, from UK, and of course Jerome Powell. He also gives a address. This is probably his last address to the Jackson Hole, because it won't be chairman anymore. So folks were thinking, what's he going to talk about? But what made a huge change in the market on Friday was his statement around Fed is willing to shift its policy rate from current levels of 4.25 to 4.5. More important was one statement that he made, that we will not only consider inflation as one of the biggest decision-making factors, but also look at what's happening on the labor side, right? So Fed has got two mandates. Price stabilization means inflation should not run high, and the maximum employment, right? So Fed was always in a tough position because inflation trajectory has been coming down, and but the labor market was hot. But if you look at the previous BLS numbers in which the labor market revisions had happened, which clearly told, the previous numbers were really bad. Now the revision shows up that it's not as strong as what we thought. And market had almost priced in 90% probability that Fed is going to cut the rates. But then PPI numbers came out, which was higher than expected. And then again, we went into limbo of, is it going to cut or not? Because now we have a higher chances for inflation. But on Friday, Jerome Powell delivered what the market was looking for, and after his speech, you could probably go and look at whatever the minute or 15-minute chart. You could see that the market ripped higher after Jerome Powell told that they're open for. It is almost given that we're gonna get a rate cut in September. The more important thing is the change in the stance of Fed. It means Fed that just doesn't pivot only for one rate cut. Now market is pricing that probably we're gonna get more than one. We may get around 2 to 3 rate cuts, and even in 2026, if inflation doesn't raise its ugly head, we should see eventually rates coming down. So this was before the Jackson Hole speech, and this is after the Jackson Hole speech. The market, the probability of a rate cut shot back up. So prior to the PPI numbers, we had close to 93%. Then after the PPI numbers came out, it fell down to almost 70%. Before Jackson Hole speech, it was 75, and now it's back to 90. Right? So that's what made market go higher on Friday, and we did recover some of the losses. And I'm going to go through what we talked about last week in terms of if we get a rate cut, what's the playbook. And that looks like a lot of the playbook has already played out, or not fully, but at least that thesis had worked out. Can Powell be removed forcefully? President does not have a power. It's only be done for a cause, and right now there is no cause. I think there will be a much bigger issue or bigger impact on the stock market if Powell is removed forcefully, because that means it casts a doubt on independence of Fed, which is much bigger an issue from the rest of the country's perspective, right? So today, many of them they buy US treasuries because they understand there is a rule of law. The government just can't do anything that they want to. Fed is little independent, and if there is any doubt on Fed's independence, you don't know where the market's gonna go. So I pray that Trump doesn't dig out some of the dirt on Jerome Powell to remove its face forcefully. What does this mean for the stock market? Lowering the interest rate means the cost of borrowing. Again, Fed doesn't set any of these borrowing rates. Fed doesn't set your mortgage rates. Fed doesn't set your business loan rates. But many times these will tend to follow. There have been times when the mortgage rates haven't followed. Because mortgage rates generally tend to follow their 10-year notes or 10-year and not the Fed only sets the overnight lending rate. But the direction or trajectory on an average is same in terms of where the Fed rates are going. So market is now euphoric, saying, hey, we're gonna get a cheaper money, and that's good for businesses. And that's why the markets recovered after the Fed, after Jerome Powell mentioned that they'll be more open to cutting rates. Jose will still have more numbers coming out before FOMC. Yes. And then things could change, right? So we will see when that happens. There's a good chance the next Fed head will not be independent. Yeah, I mean, that would be concerning to us. We are not out of woods yet. Okay, so last week we talked about playbook for a rate cut. So what I went was to go back and see, we haven't got a rate cut, but markets know that we're going to get a rate cut, and market is always forward looking, right? Because market anticipates this going to happen and it wants to take an action right now. So last week we looked at mid cap and small cap stocks generally do good when you get a rate cut. So there is a ticker VB, which is a Vanguard small cap index that is up 3% after up 3% yesterday on Friday after the announcement has come out, right? Value style investments do good, or equal weighted S&P 500, which is RSP, was up close to 2%. Potential beneficiaries include rate sensitive, right? So rate sensitive means companies that leverage, that has got more loans on their balance sheet. If the rates come down, they'll have to pay less in interest. Cyclical industries such as home builders, real estate, banks, right? These all were up. Like home builders were up 5.1% XHB. And XLRE is a ETF for real estate. It was up like 1.6%. Consumer discretionary financial sector, which could get a lift from upcoming Fed pivot. XLY, which is consumer discretionary, was up 3%. XLF, which is financials, is up 1.65%. If the cost of borrowing comes down, businesses and consumers will be willing to go and spend something which is not a necessity. Right? I was eyeing that new toy, but I can't borrow at 6%, 7% rate. That's too expensive. But if that comes down lower, I'll be able to spend a little more on those discretionary items. That's why the discretionary went up. And the financials company, they always benefit if people and the businesses borrow more. They'll be able to lend more, and this will also include a lot more corporate activities, etc., which means you can, on an institution side, you can make more money. So the financials were also up, right? So the playbook did play out on Friday, I will say, right? Now, what will happen once we get a rate cut, whether it's going to be, sell the news, who knows? What we don't know is, is 5% justified or 5% is euphoric? No one knows right now. So if you're investing in any of individual companies, you need to know about the details of those companies. What does RSP stand for? RSP is an ETF for equal weighted S&P 500. So S&P 500 SPY is market cap weighted. If the top biggest companies do better, the S&P will continue to run. And I think that's one of the pet peeve of many value investors is S&P is being driven by just top 7, right? What we call as a max 7. Take Tesla out because that hasn't delivered this year, but top 6. And they say other 493 companies have not done anything. But if you look at RSP, that's a time when we go to this. If you look at RSP, right? RSP also delivered on, this is a weekly one. Hold on, 1 year, 1 day. RSP hit a new all-time high as well. It is why? Because there are a lot of companies, the biggest companies don't need loans, right? Google's of the world, Nvidia's of the world, Microsoft, there's got a very cash-rich balance sheet. But the smaller companies might need loans. So, but if you negate the impact of the bigger companies and consider everything as equal, that's what we saw on Friday, that a lot of other companies' stocks also rose, and the equal weighted S&P 500 was also up nicely, right? So, but from now, if you look at it, even equal weighted have performed well, like 8.45% against S&P 500, which is close to 10.5%. I think this includes dividend. So the whole story around driven by only top companies, not true anymore, at least over the last 1 year. Maybe, yeah, even for the year to date, not true anymore. They're kind of, it means they're kind of getting converging. It means we're getting a lot more broadening of the stock market, which is good. We don't want only fewer companies to carry on the stock market, right? What if the story behind those fewer companies, and we all know what the story is, it's all about AI. What if that story goes out? I'm still a little concerned if that story goes out, because we look into the other sectors and then we'll see, what driving those sectors. But it's good to see that the equal weighted RSP is also its 52-week high. That's not lagging behind. From an equity side, animal spirits are back. And what I look at when I say animal spirits are back are some of those unprofitable companies for now. Some of those companies whose cash flows might be very late in future, if they ever get to those cash flows, but you want to bet them on right now. I want to find the next Facebook. I want to find next Google, right? This is more like a VC investing, right? Some of these companies should not be private, should not be in a public, but here they are. And those annual spirits you'll see are back here. ARKK, which is, if you want to only track one ticker, ARKK is one of the tickers which is invest in innovative new tech companies. Doesn't matter whether they have a revenue right now or not, but some of the bets will work out, and this will generally be very volatile. If you look at ARKK, it had a huge swing on Friday. Animal spirits are back. And before you think ARKK is up 34% for the year, let's go back and look at this trajectory of what happened to it. In 2021, when we had a lot of free money, free checks being sent out, everyone became Warren Buffett in 2021. Easy money, easy to make money in the stock market. It's still haven't recovered. It's still sitting at half of its 2021 high, but had a good recovery in this year. It's up almost 35% for this year. When the liquidity becomes tight, where we saw the interest rates started to increase, these companies that don't make money in near future get punished. And that's what happened with ARKK, which is an ETF, right? So I went and looked at the other so-called retail favorites, YOLO companies. Let's go to the moon all together and look at this change percent column that you see is on Friday. It's just on that day. And this is where you say animal spirits are back. Open Door was up 40%. And there is a different story behind Open Door. Any Open Door investors here, or I shouldn't say investors, any Open Door players here, speculators here. And it's perfectly fine to make money on Open Door, right? I'm not debunking or I'm not against making money on this one. Well, let's make sure we don't call it as investing, call it as a right way, which is speculating, and that's perfectly fine. It's legal and you can do it. No one in Open Door? Come on, no one wants to swing? You guys have been corrupted by me? Okay, so there's a different story around Open Door also. Their CEO has been pushed out. There's some activist investor in it. And this company, I think it came IPO through SPAC, again, during the heydays of free money in 2021. And some part of time it was $40, and then it was like 50 cents. And over the last couple of months, the huge interest in Open Door, and the stock has been it's been very volatile to say the least, right? So still very, very risky. And I did hear the CEO, not the CEO, but the fund manager who's been pushing this on one of our podcasts. And I don't know. All he was saying is Open Door should use AI to reduce their cost and now move into different areas. I don't know how far that business model will work out. There was no clear direction of what he wants. So it could be just pump and dump, who knows? So you be very, very careful if you want to trade in this. Okay, so I don't have a volume for Friday, but it trades a lot. It's got a heavy, good option premium. If you really look at it, going out 27 days, 30 days out, you're looking at like $1.35 for selling close to at the money $5 short put. That's almost 30%, not 25%. Yeah, close to 25% for 30 days. You have a 25% cushion if we are wrong. Right? So IV is through the roof, looking at 3 digits implied volatility because it's so volatile, and that's why the premiums are high. So that attract a lot of retail investors into this. Look at the open interest, 37,000, right? It's in tens of thousands. It's become a new hub of options activities. And it's not the first time I'm seeing this. I've seen these kind of activities in different stocks during different phases of the stock market, right? So anyway, so the open door, Oscar. So for these, the stocks that I listed here are the stocks that last week when we were looking at super investor moves, we said these qualify as a retail favorite stocks, right? All of them had a great Friday. They were all up. Retail investors is back in, right? Everyone can make money. So those sentiments are back in the market, at least for Friday. We'll see what happens next. Sorry, Sam, I see your hand is up. So go ahead and unmute yourself. Your question?
No, I have a comment on Tesla.
Mhm.
Back in 2021, I can't remember her website. She's kind of, I don't know, she's kind of a Falun Gong lady. She also probably got the student visa in 1990 because of the persecution in crackdown in Tiananmen. But she said that the reason the Chinese leadership was letting Tesla into China carte blanche was so that every other company learns its tactics, and evidently that's true because now Tesla's a follower, not a leader.
Yeah, and I don't um blame China for this. This is a playbook that we have seen being played out not only in China, but in some of the other countries also, wherein they don't want foreign competitors to come and conquer the whole market. Sometimes they will have some restrictions that you have to tie up with a local provider. I know India does it all the time, that if it is a nascent market, you'll have to tie up with some local provider. And then only you can enter into the market. China's little different story because in terms of not much respect for that IP. So if you're operating in that country, you might just figure out and reverse engineer your secrets and then, beat you at your own game. Chinese EVs, and this week there was a new, I hold a stock of NIO and I was following it. The EVs coming out of China are way superior than what we see, what Tesla has. When I say superior, I'm not talking about, let's say, how they perform let's say, if you're involved in an accident from a safety perspective, but from perspective of the amount of the features and the luxury that you can pack into a car and at the price point, which is unbelievable. And that's the reason now, Tesla is losing market share. And Tesla is losing market share not just in China, but if you look out on Friday, there was another report that now they lost market share in Europe also. Volkswagen has taken back the leadership in Europe in terms of EV sales from Tesla. So I know there are a lot of bulls on Tesla, but now those bulls also understand that the story of Tesla is not as an EV car company. So we have moved beyond the car, I think a year ago or 2 years ago, saying it's a different company. If we want to invest in Tesla, EV should not be your bullish thesis. It's all about Optimus. Batteries storage business has been doing much better. It's been growing like crazy, and it's robo taxis and all that stuff. So I'm not surprised, from a Tesla car business, eventually it's a car business, right? You can't download the car. You have to manufacture, the operating margins are back to how the normal car operating margins are. So, and I know, I mean, Tesla is a very most loved and the most hated stock. You can't ignore Tesla. Either you love Tesla or you hate Tesla. But it's a fun to talk about Tesla. All right. So we also had a manufacturing and services PMI data, which came. So the manufacturing PMI came at 53.3, which is higher than 50, means it's an expansion mode, and it came, I think, for the last 28 months or something. It has been below 50. So now it came in higher than 50. It was like 39-month higher, a new number, which kind of a given indication that our manufacturing is now in expansion mode, right? So which is generally it's a good for economy. So that also gives a little boost for the stock market if economy continues to grow, right? It means the economy is not contracting. Again, this is just one data point, but all this stuff together is what causes the movements in the markets. But we did have a tech stock in which there was some profit taking. So Nasdaq has not recovered. So if you look at a QQQ, that has not. It is still hasn't recovered from its previous week. There's some profit taking that we saw in Nasdaq listed companies. QQQ is an ETF, or it had 3 red days continuously, and then on a Friday we did recover a bit, but not to its all-time high that we had last week. What we also had was Walmart. So Walmart shares were down 4.5%, and Walmart is like one of the best retailers in terms of managing the cost, managing the supply chain, and if their earning guidance, I mean, from the previous quarter results, they had both beat on top line as well as bottom line, but it was a little guidance that's to earnings guidance, which kind of caught the concerns in the markets, because if Walmart cannot manage the cost, then it means the other retail companies will have even tougher time, because this is the biggest retailers. If Walmart cannot squeeze out the suppliers or cannot squeeze out the efficiencies from the supply chain and to keep the profit margins intact, that it means others probably going to have even tougher time. So Target, Dollar General, they also fell. Target have its own problem. I mean, if you look at the Target shares, oof, this is like, you could call as like falling knife. Every time you think that, oh my God, maybe how far it'll go down, it's not a good day for Target. And I think Target also had a change in CEO. Now, for obvious reasons, the stock hasn't been performing as against Walmart, whereas Walmart, let's look at Walmart at the same time, WMT, right? Walmart trajectory is up, where the Target trajectory is downwards. Both are in the same retailing business, but I think Target is now stuck in terms of what it stands for. Okay. So people who have money or want a little more higher brand probably go to higher or better stores than Target. Those are feeling the pressure from tariff and have to manage the budgets, they go to the Walmart. So Target has to figure out what it actually stands for. Shu asked, what tool are you using? This is Thinkorswim brokerage platform. I mean, any brokerage platform should be able to give you these charts. So depending on what broker you are with, use that tool. I like Thinkorswim. I've been with them for now almost 9 years. So little inertia. I don't want to change to anything else. Vin says, Kathy Wood is bullish on Tesla. Kathy Wood have always been bullish on Tesla. She made her mark by giving, some predictions, very outrageous predictions on Tesla way back in 2018, 17, which actually turned out to be true, right? When everyone thought that Tesla was dead, the company wouldn't survive. It's a car company. Kathy would make a prediction. No, this stock will be $2,000. This is like all pre-split, right? And she got a lot of recognition from the street for that bold predictions. But the car story, EV story is over. There are a lot of other EV companies around the world. That story was there in 2017, 18, and in 2021, we saw that liquid. It worked out well. And that's why ARKK's biggest holding used to be Tesla. But since 2021, all her predictions around Tesla haven't really panned out. Or for that matter, predictions around Zoom haven't panned out. So, but market has a tendency to put, a lot of these fund managers whose predictions comes out true once, and we have a tendency to believe that, they'll find the next gem also. And she has always been bullish on Tesla. It's not the first time. And at some point of time, she's also talking her book because Tesla is a big position for her own portfolio. Oh, let me see. Chinese EVs beating Tesla on price as well as features. Yep. All right. Other big news was US government takes 10% stake in Intel. I think Aditya mentioned that. I didn't see it coming. I knew like Intel is strategically important for us in US as, let's say, Boeing is. Right? There is no other US company that manufactures chips that have got a fabrication plants. But I don't know, is it as an Intel shareholder, I was livid because Intel didn't get any extra money. So what Howard Lutnick, our Commerce Secretary, mentioned that the subsidy that Intel had applied for under the CHIPS Act, right? It was supposed to be a subsidy. They should have gotten it for free. Now they are paying 10% of their company and probably gonna get the same amount of subsidy. Right? This, in a way, it also feels a little extortionist to me, saying, come on, I was entitled to that subsidy anyway. Now I have to, give you 10% of my company to just get the same cash. That's what happened. But my personal stuff around Intel is they need these 4 C's to survive. Right? And if some of you know, somehow I have 4 C's. So 4 C's for Intel is they need cash. If we look at their plans of building these fabs are very, very costly, and that's what basically caused the exit of Pat Gelsinger. Each fabrication plant cost $40 billion to $60 billion. So they got some cash now because there's cash infusion coming from government. Right? They need a capacity to build the plants. It means they make sure that the ASML is able to supply the machines to them, and the other equipment suppliers are able to supply machines to them. I think I'm okay. The supply it's in the whole chip fabrication. It's like oligopoly, or in some cases monopoly. If you want EUV machines, there's only one company that supply it, right? So they need to have a capacity which they are building, and hopefully they'll get to it. Capability, I have a doubt on this one. Do they have the right capability to compete against their biggest competitor, which is TSMC? I don't know. TSMC has perfected this manufacturing process over many, many years, and Intel has just fallen behind. And finally, the biggest one, you get all three, but you don't have a customers. What are you gonna do? Because customers won't come because you don't have, maybe I should add the fifth one, credibility. Would you be able to give me the chips if I'm Apple and my business now is dependent on you because, hey, if my iPhone needs your chips, are you credible enough? Can I depend on you to deliver me the chips in time for my next iPhone launch? I don't know. I don't think Intel have built that credibility yet. If you go back and look at Intel, how many times they had to move their dates for the 10 nanometer and 7 nanometer chips. They just couldn't get the stuff right for their own internal consumption, in which you have a lot more visibility into what Intel products are coming and when those products need the new chips, and then your manufacturing arm can't build the chips for you to consume. Now here we're talking about external customers. Agreed that the US government might force NVIDIAs and Apples and AMDs of the world that they have to take some chips from Intel because we need to keep Intel alive because it is strategically important for us. Otherwise, we are always dependent on TSMC, which is Taiwan-based company. They are building the plants in US, but we don't have the latest and greatest plants, right? Which is like 60 miles away from China, separated by an ocean body, right? So risky for us to depend on all the chips that our military needs, our economy needs, on a company that is so close to, physically so close to China, right? So we need to build our capability. But I don't know, throwing money behind Intel is gonna bring all these stuff or not. I have a doubt on last three. So do you feel Intel is a buy now? I'm not rushing to go and add to my Intel position. It has taken away maybe the first two. You got more cash, your equipment supplier will be able to give you the equipment so that you can build the capacity. But I have my doubts on these three. I want to see some proof that Intel has built the capability, credibility, and are actually getting additional customers. So if in this the recent earnings, Intel had mentioned that they are stopping any work on 14 angstrom plant because there is no customer demand. And they said this will be only dependent on customer requirement. We are no longer doing, you build first, then the customer will come. We are changing our methodology, let customer demands, and then we'll build. Let me see what Intel has to say in the next earnings call. Then we'll figure it out. So I am not, we will probably fix these two. I'm more worried about these last three. So not gonna go and buy Intel stock. That's just me. What else is on the equity side? This is when I was reading through the Bill Ackman Pershing Square's shareholder letter, and this is what Bill holds. Its biggest position is Uber. Almost 20.6%. And Bill Ackman is generally thought of a very concentrated position. They'll try to hold 8, 10 companies only in their portfolio. So when you have a fund manager who do so concentrated, they'll have to have a much better thesis, right? Not like me, who will have like 40 positions. And then if one company goes down to 0, yeah, I'll be hurt, but I'll survive. Not that for Bill Ackman. So they'll have to do a lot more due diligence. So I was surprised to see that Uber is their biggest position, which is almost 20.6%. 1/5 of their, little more than 1/5 of their portfolio is in one company, right? So I did tweet about it. Some interesting tidbits was, first of all, why do I even want to look at Uber? Oh, Pershing Square Capital, because This firm has generated 16.4 annualized net return for 22 years. Right? It's very difficult to beat S&P 500 over a longer period of time. Most of the fund managers don't, right? But if you get 16.4% annualized net return on 22 years, you are one of a few who are able to beat S&P 500. There he talks about his investment thesis on Uber, which very well aligns to what, the thesis that I've discussed with you when I reviewed the Uber, earning results, capital light, scalable, expanded partnership with EVs. This was a little concerning. I have is Robotaxi gonna eat their lunch, right? But if you have a partnership with all these EV companies, you basically supply them with the you manage the demand and the supply from the riders and the drivers, and EV companies manage the car side of the business, right? So go and read if you are interested in Uber. Maybe go and read what its thesis is, right? And if you look at the previous recent results, Uber had a beat on top line, bottom line, and now from being a cash incinerator, which they were a few years ago, they are a cash flow positive company. They're buying back shares, right? So the new CEO and the new CFO, they've turned the company around. And if you listen to them, they are also doing a lot of shareholder friendly actions. So I'm happy to hold Uber, and been in Uber since 2019, so almost 5 years, right? And in 5 years, if you can bring down your cost basis by what, 13 out of 43, that means 30%, little less than 30%. I need another 5-10 years to own it for free and clear. So even if thesis is a little wrong, I have a lot of a cushion, right? So that's around Bill Ackman taking stake in Uber, but I also wanted to see who else in Uber, right? So I looked at from all these 89 fund managers, who else also own Ubers. Altimeter Capital, no surprise there because it's a San Francisco-based Brad Gerstner's firm, and these Brad Gerstner, Jason Calacanis, they all are besties. They have stake in each other companies, and I'm not surprised that second biggest is Altimeter Capital. Bridgewater Associates, Ray Dalio, they increased their position by like 500% and close to $350 million. David Tepper had reduced it, but still have like almost $250 million. So yeah, there are folks who still want to stay in Uber. Over, if you total it up, it's almost $5.5 to $6 billion from these fund managers in Uber. I feel okay in the company of these. Mike, Uber is part of SPY as well. Yes, Ackman is manipulator. He took positions in fixed income during COVID, went on drama. See, everyone on CNBC has hidden agenda. Why pick only on Ackman? Everyone has hidden agenda. You don't call him manipulator. It's like people don't do their own study of what the conflicts are. So if from that perspective, that's what I'm saying. Don't go and buy because Bill Ackman had bought it. Go and buy if you like the thesis around Uber, and you buy into that thesis and you think that thesis is yet to play out. Never go and buy based on what Warren Buffett bought or Bill Ackman had bought or Bailey Gifford had bought. I look into these super investor moves to generate idea. It might give me some idea about it. Then I will go and build my thesis. And if I buy into the thesis, yeah, I'll hold the company. We look at a company in which the lot of people in Q2, these super investors bought into it. But I discussed that company with you. Says that's not for me, right? Doesn't gel my investment thesis or what kind of investor am I. So you'll have to build your own thesis around the companies. Don't blindly follow. So I can't blame Bill Ackman saying, he had a lot of puts. He bought puts on SPY and he made what, $2 billion or something. I remember there was a lot of consternation. People were angry that Bill Ackman came and cried about what's on the markets. So looking at a fear and greed index, we're still in the greed mode, so means little caution, and we'll go through that framework when we look at a Howard Marks stuff. Mike say you haven't seen other hedge fund this kind of TV drama. I've seen a fund manager coming and pumping the stock, and then when the commenter asked him what this company does, he had no idea. He had no idea what the company does as well. So I don't put any faith on it, whatever I watch on CNBC or Bloomberg. Looking at a sector-wise performance, congratulations, all sectors are now green for the year. Right? We have in previous weeks, we looked at that the healthcare was still in red, but at least barely eked out positive performance for the year with 0.21%. S&P 500 close to 10%. And the top are communications. Under the communication, some of the tech companies are hidden, like Meta is part of this, right? Then we got industrial sector. And you might be wondering what the industrial sector has to do. It's all AI play. Now, this is what little bit of worrisome to me. Even though we are looking at little more widening, like I talked about earlier, that we are seeing more broadening of the companies that are doing well, even at a sector level. It's not that, tech and the communication sector is up like 20-30% and others have not performed. Look at it, top 4 or 5, top 4 pretty close to each other, right? Between 16% and 13%. But if you double click on this one, why is industrial so high? What's your thought? Why is industrial sector is as good as companies like Meta? Are industrial companies not, the margins are down or they are a lot more capital heavy? Why industrial sector is so high? It is because it's the same thing. It is driven by AI theme, data center. Yeah, Sridhar got it right. These are the companies you need to build a lot more data centers. Look at the utilities. Utilities is, you need the utilities for generating power. A lot of it coming from the same theme. This is what little scary for me is these top 4 sectors, or maybe include 5th also, are all driven by one overarching theme, which is AI. And if we see the cracks in that theme, I'm not saying that we are seeing cracks, though we saw a little bit. There was a report from MIT that came out this week, and that's why the tech stocks were down. I think Elena or someone was saying the tech stocks fell down because there was a report from MIT which says 95% of the AI projects don't live up to their expectations. Right. But we are very early in the AI game. I think it's too early to pull the curtain down and say game over. Even though whatever the MIT report had said, I have yet to go through the MIT reports. I don't want to either go, negate it or associate it with it just now. But that's what caused a lot of tech sectors or tech companies to come down, was MIT report saying AI projects are not doing what companies thought they would. And here we have billions and hundreds of billions of dollars, and maybe $1 trillion getting into building the capacity to have a better and better AI. And if the AI is not helping businesses to generate more earnings, that's going to be an issue. But I'll wait to see. I don't think it's a judgment day yet, right? But this is a little concerning. All top 4 or 5 are driven by the same theme, which is AI. I wish there was a little different themes, but I guess that's how the stock market works. Either you stay out of the stock market, or saying, you know what, if you don't want to participate in this AI theme, but we also had these internet themes. And in 1970s, 80s, it was a conglomerate themes, right? All the big conglomerates were getting the highest valuation. So I guess that's how the market works anyway. It's not just this time, just that the themes keep changing, but market is probably driven by mostly one maybe big theme. Anyway, so what did I buy or sell this week? I did not buy anything. No stocks buys, only option trades. And I sold a little bit ICSH. So if you recall, ICSH is a short-term T-bills. This is what I use to park the cash. It gives you almost 4.8% yield. And if I have a cash that I don't need to deploy, I'll just buy ICSH and hold it. But I sold some of the ICSH because I got a bills to pay, right? I need money to survive. I need bills to pay. So I moved it from my brokerage account onto my banking account to cover for expenses. Other than that, no other movement in my portfolio. Alan is asking, what's the deal with OpenAI and the buzz about spending trillions and their IPO buzz? So there were 2 things that came around OpenAI. One was Sam Altman also made a comment saying he's seeing a bubblicious kind of feelings around the AI stuff, right? There's a lot of AI companies coming around. Like yesterday, where there was a startup page, probably all, like 10 out of those 11 pitches were all related to AI. So Sam Altman made a comment that maybe we are entering into a bubble territory, a little more euphoria. I don't know what the exact words he used, but to the tune of saying this seems to be a little euphoria in AI. Maybe he meant to say that apart from OpenAI, all these companies are coming around and getting investor attention and getting investor dollars. That's euphoric. Because those companies have nothing concrete, OpenAI has stuff. I don't know what he meant, but that caused some jitters to the market. Number 2 was looks like some of their insiders, they sold some of their holdings at a price point which will kind of value the overall OpenAI at close to $600 billion. I don't know the exact number, but maybe someone can Google and correct me. And that's what $500 billion, Pankaj. Thank you, Pankaj. Some absurd number. So that makes it maybe second biggest or second most valued private company after maybe SpaceX, right? So that was a little concern. So I think it was the first comment which says maybe we are seeing a little more euphoric. Which again, and then we had an MIT report came out, and that was the reason where some of these tech stocks, which have been riding the wave of AI, they all fell down in unison. All right, earnings next week. Only one earnings that matter for next week. And please, please, please don't go on holiday on Wednesday. After Wednesday close, the granddaddy, the biggest company on earth, the company whose market cap is more than the overall stock, the market cap of all the companies listed in various stock exchanges of the world, is going to report earnings, which is NVIDIA. And so that could be a big volatility move in the markets on Thursday based on what NVIDIA reports. Especially the tech and all the AI related stocks, will go the way NVIDIA goes. And sometimes it might also give you an opportunity. If NVIDIA doesn't report great results and the market punishes all the stocks, there might be an opportunity for you to buy some of the stocks that you love at much cheaper price. So make sure you have your watch list ready and make sure you have a cash available in case market punishes, everyone, whether you are related to AI or not. And that does happen. That has happened in terms of sometimes market is indiscriminate in punishing all the companies. So that might be a time to go for some shopping. I don't know. I have no idea what NVIDIA gonna report and how the market is gonna react. Even if you know what NVIDIA gonna report, how market is gonna react, no one knows. Even the NVIDIA CEO or the CFO would know. But it's gonna be an interesting Wednesday as always. And but I've not seen some watch parties for NVIDIA anymore. I remember, I think in 2023, there were watch parties happening in New York. Folks invest will get together and in a bar or pub and watch NVIDIA's earnings call on big TV on CNBC, and that was like a bubble. You think, oh, that's too much. Is there a way to know what NVIDIA gonna report? If there is anyone who knows what NVIDIA gonna report, the CFO should be in jail. No, there is no way for you to know. That means that someone has leaked the information to select individuals. You might guess what the market thinks that NVIDIA is going to report. You can look at Yahoo Finance and see what market is thinking about it. Let me just give you NVIDIA, right? NVDA. But what it is going to report? Nope. So, right. So average estimate is from analyst of 41 analysts that track. It's one of the most tracked stock that they should be reporting $1.1 of EPS and average estimate $46 billion of revenue. So top line $46 billion, EPS, bottom line $1 and a cent in EPS. Now, what they gonna report, we'll only get to know on Wednesday. But Alan, Publishers, that's funny. Unfortunately, Publisher loses flavor quickly, though I don't think that's what happened with ChatGPT. Yeah, I mean, ChatGPT's revenue has been growing like crazy. Right? So we have seen that, but we only get to know that it is a bubble only after the bubble burst. Yeah, market can stay at higher multiples, but that doesn't mean it's a bubble. I don't think right now that market is in bubble, but that's just me. Is there overvaluation in the market in some sector, some company? I think so. But is it crazy or, that I think that everyone is bullish? I don't think so. There's still a lot of caution in the market. Right? That's the reason. I'm getting ahead of myself. So let's wait for the InvestCon framework. We're going to get back to that topic. Can insider trading give us a hint for the earning report? Nope. I don't think. If there was a way to know this, your hedge funds and the people with much better technology would have already exploited it. Look at all the insiders. Look at Palantir. Insiders have been selling the stock for months. They reported another sale of stock by, I think, by the CEO, by the CFO, top leadership. What's happening to the stock? So I don't think in a short term, you can look at these reports and say, oh, insider is selling, my stock is going to go down. Insider could be selling for all the reason, any reason. I want to buy a new mansion. As a CEO, I need $20 million. I go and sell my stock. 90% of my wealth is concentrated in one stock, right? That's foolishness. That's very risky. I'm not doing a good job as a financial or manager of my own family. I want to diversify. Maybe I'll sell a little bit of it. That doesn't tell anything what the stock is gonna do. Look at Palantir. Insiders buys, and I don't know if they ever bought or not, but if you look at insider sales, huge amount of sales on Palantir. Do we see here? I know Finviz shows insider sales and buys. Haven't looked at Finviz for months. So look at this. Sale, 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 sale. Never ever buy, except whatever you get as an option grants, right? No one has gone and bought it at the market thing. I think the stock is undervalued. I should buy it. No, it's all sale. Let's go back. Oh, this is August 20. Oh, there's some, we saw some buy. But mostly sales. Yeah. So that doesn't tell us much. What about call put buy volume in advance of earnings? Let me ask a question. There are many option traders here. If I buy a put, I think, do I pray the stock will go down? I might be trying to hedge because I already have a lot of stocks. I'm just trying to hedge my position. It's like if you buy an insurance on your house, are you buying it because you think the house is going to burn down tomorrow, or you wish the house is going to burn down? No, you're still bullish on the house. So it's again, investor sentiment does it. Sometimes you may be able to, sometimes you may not be. There are a lot of services that will give you this information. Go and look at historically how many times you actually got a signal and which worked out and which did not work out. I've stopped looking at any of these things because in the long term, it might work out one time, right? But in the long term, I think it is immaterial. All right, looking at the crypto side of the market, on Friday, everything ran up. Crypto also ran up. And the Bitcoin, I think at some point of a time was close to 112K. And this is as of today morning, now back to 114. I think on Friday, it was up to 117. Ethereum continued its move. There was a Ethereum watch party hosted by Bankless. Again, Bankless is one episode that I do listen to because they focus a lot more on Ethereum ecosystem. They get some good researchers, and sometimes they also do these watch parties. So I went to my daughter's school to drop lunch, and I was looking at a Twitter, and I saw, wow, there's a watch party going on, right? But Ethereum did not hit an all-time high. Probably those who were attending the watch party got a little disappointed. The all-time high is, I think, 4898, and or somewhere like that, and it did not hit a new all-time high. But there's some good recovery on some of these crypto assets. Again, it's like when you think that the loan is gonna get cheaper, the prices of every kind of assets go high. But if you have money sitting in the bank, that's where you lose. So all the assets were high, including the crypto assets. That's on the crypto side. Okay. Next, I'm going to talk about the Howard Marks and InvestCon. But any other questions? What's the sentiment on healthcare? We saw recovery in UNH and a lot of small cap popping. What's a good way to monitor the healthcare sector, biotech and pharma? I don't invest in individual companies in healthcare because I don't understand the sector. But you can look at how those ETFs are doing. If I do a healthcare exposure, I'll take through an ETF because this is very convoluted space, regulated space. One government regulation can make or mar any company, and I don't want to be in that boat. So I picked XLV is my preferred way. Or if you want to do a biotech, XBI is a biotech ETF. You could look at that. I've sold, after the whole UNH fiasco, I've sold on puts on XLV and made some money around that, right? But that's because I just don't understand. I mean, it's too complex, too hard. It's in my too hard pile. So that's why I don't do individual positions in this. Maybe the best investing strategy, buy SPYQQ, invest in that, accept and exercise plans as long as you live long enough to benefit. And I don't disagree. If you do just SPY, you will do better than 65% of fund managers in the Wall Street. What's the latest SPY report? I don't think we have the SPY report after Q2. Well, let me just pull out SPY report 2024. Do we have a 2024 yet? Sorry, 2025 it don't. 2024. I did not know it is 65%. I just threw the number. I know somewhere around 65% of all large cap US equity funds underperformed S&P 500. Right? In 2024. So we would have just done better than a lot of these fund managers, right? And if you add QQQ to the mix, it's very difficult to beat the market. And I think I've mentioned to you over the past 5 years since I've been doing this, I've changed my own thesis around how I want to invest. As your portfolio grows, you realize it's becoming more and more difficult to beat the market. Do I own individual companies? Yes, I do. And you guys look at my portfolio at the start of a new month, and I still hold individual companies. But my overall allocation to the ETFs has been growing over past 5 years. As I become more educated in the market, I realize how little I know about about the companies, right? The more I know about companies, the more I realize how little I know. When I was not that informed, I thought, oh, I figured it out, right? So how does one get into private equity? Private equity is actually coming into your 401ks anyway. You can look into there are no I mean, Apollo and State Street have filed for ETFs, but I don't think they are trading yet. But the risk and the default is increasing. Yes, private equity is having tough time in terms of raising capital, and that's why we're looking for new buyers and retail investors. All right, so let's move on to our next topic, which is based on recent memo from Howard Marks, the calculus of value. So I'm not going to go through the whole memo, but I took help of some of these LLMs to summarize, and then I added my own flavor, modified it. right? So basically, at a high level, it starts with telling you the difference between value and the price. So first of all, most of us, I didn't know about the value and the price difference when I started in the market. When I think whatever looking at Nvidia 170, 180, that's a value. No, that's a price what we are seeing, right? So there's a difference between what the value is, what the price is. There are few things that you can value, few things you cannot value. You can only price. Things like diamond ring, painting, Bitcoin. You cannot value Bitcoin. You can only price Bitcoin. Price is what someone is willing to pay for it. When you say, I want to value a stock, value means how much cash is going to generate over the lifetime of its business, and discount it to what's up with its present value would be. That's how you come towards the valuation. That's how the value investors will work on. That's how when the fund managers says or your investment bankers, when they come and say we are valuing the company, that's where they look at, try to project what your cash flows will be out in the future. And for a going concern, project it out, discount it using the risk, your discount rate, what the current value would be. The price is what the market is willing to pay. So if the value comes out to be, $100, sometimes the market is willing to pay much higher price because there's a lot of demand for it. So price is driven by the demand and supply, and the value is driven by the quality of the business, right? And market could be overpriced, though we use the wrong term saying it's overvalued. Market can't be overvalued. It could be overpriced or underpriced, right? But we stick with the term that's been used for years. But great investors know the value of what they hold. And when they see that the market is willing to give me those companies at a lower price, which is lower than the value, they'll scoop in. So referring to, let's say, Nvidia report bad results and the market punishing the stocks in your portfolio. You know what you own in your portfolio. And if you think you're getting a better pricing than what the company is worth, that's a time for you to scoop in. But if you don't know what you're holding, you'll end up into, I think somewhere I commented on Twitter where folks were saying, oh, great red day. I hate this. I'm like, you should be very happy if you hold this a portfolio because the stocks are down 20%. You should go out and buy more because you want to hold these businesses. Now you're getting 20% discount. It's a great day. Why don't you like the discount? The problem is if you don't know what you're holding. That's the biggest issue. So you just are swung by the markets in one direction and then in another direction. So if you hold the business, if Mercado Libre or some other companies that I hold, and I think I'll be willing to buy more, if it gets down 20%, I wait to buy it more. Right? Sometimes I hate the companies that continue to go up. We get so overpriced, like, gosh, I didn't get a chance to buy it more. So if some of the companies falls down, I'll probably go out and buy more. I'll be happy I got a chance. A market gave me a chance to buy at a discounted price. So understand the value. It talks about the difference between value and the price. Now, an overvalued asset can become more overvalued, right? So I put a notation like Palantir. I love the business. I love the technology. But stock price, it is overpriced, right? It became I should be actually overvalued, overpriced, and then extremely, and then crazily overpriced, right? If you go back and look at some of our previous discussion, I said, I'm okay to hold some of the overpriced stocks. But this is like egregiously overpriced, and hence I sold like 70% of my Palantir. I'm still holding 30% as a gambling chip, right? Now, many fund managers will say, oh, this stock is overpriced, I'm going to short it. Or I'm selling it from my portfolio because this is overpriced. and the market will converge to the right pricing. How long can the market be stupid to pay 100 times sales for Palantir? How long can market be stupid to pay 80 times sales for Snowflake in 2021? But sometimes the overvalued can stay overvalued for much longer than what you can afford to hold a short position on. That's why I don't short the stocks directly. Market, I think Maynard Keynes had said, right? The market can remain irrational longer than you can remain solvent. And this is the worst thing to happen as an investor, that your thesis was right and you still got wiped out. Like someone who on the Reddit first post that we look at, if you go and look at those three tickers, right, they have lost money. But only after his account got wiped out. Because market will stay irrational for much longer time. So don't go and sell your stocks just because I think this is overpriced, I'm gonna sell it. That's trying to become, you're trying to time the market, which no one has been able to do it. You want to trim something? Maybe. I still hold a lot of companies which are overvalued. At the end of the day, the calculus of value is what you get, price is what you pay. So buy a company, over the lifetime of a company, you're gonna get a returns in terms of dividends, in terms of their buybacks of the share, which increases your per unit dividend, etc. That's the value you get. Price you pay is a stock price, that the ticker price that you're looking in your trading platform, right? Price changes are driven by shift in investor psychology. It's all based on mood and momentum. And there is a way, there are sort of traders who say, we only trade momentum. Great, nothing wrong in it. If you can find out how to do it. And that's more on a trading side. You may not be investing, but there's a ways to make money. You can try to make money through trading. Then you will focus on what the investor psychology is. You don't care about how great the business is or how bad the business is. All you care about it, what's the other investors thinking about it, and what are they willing to pay me for it, or what price are they willing to buy me for it. And short term, market is mostly driven by investor psychology, or probably all times driven by investor psychology. Long term is the business that will count. Now, depending on what your outlook is, play accordingly. Right? For active investors seeking superior returns, I think someone said, I think this company is great. But everyone knows that this company is great. They will already bid up the price. If the consensus of the investor misunderstand, only then, if you understand that the stock is undervalued where the others don't, you have an edge. If the market price is too low because others haven't understood and you think the value is higher, then you have an edge. Or if the asset value increases more than anticipated because of unforeseen increase, then you have an edge. That's why it's so difficult to beat the market. Is not that you have to be right, but others have to have an opinion which is different from yours. You can control your own opinion, right? But if others also know that this is it's the best company in the world, they will already bid up the price. So you have to find companies that are non-consensus. It could be either on the short or on the long side, both. If the market is thinking this company does deserve 100 times sales valuation or pricing, and you think that's too much. You go back and look at the history of any companies who have had 100 times sales pricing, how they perform. You do your own due diligence, you do your own study, and I think that's too much, right? Then you can take your position accordingly, which is that the company's price will go down, may not be in a short term, but in long term, it cannot sustain the pricing that market is currently giving it in. So it can happen both ways, on the higher side as well on the long or lower side. Okay, so I'll not go through this, but let's look into. Then he provides a framework which I like, called InvestCon. So before we get into InvestCon, we're looking at it basically picks up from the DEFCON, right? That's a term that we heard from our government. Basically, there are different levels of DEFCON. DEFCON 5 means it's a normal carry on day-to-day life. DEFCON 1 is we're gonna get into war, right? It's a war footing preparation. Similarly, for InvestCon, he came up with a framework for 6 InvestCon, right? Number 6, stop buying. Right? Don't buy anything more. Number 5, reduce aggressive holdings and increase defensive holdings. Number 4, and all the way to number 1 is go short. It's like the last thing you should do. I don't think it'll ever go on a number 1 because of the reason that market can stay irrational longer than my portfolio can stay solvent. But number 2, eliminate all holdings. I don't think I'll ever do number 2. What do you think? Look into your own portfolio and your own thesis. And I think one thing which it does not include here, so this is based on what is seeing in the market. I would add one more thing to this is what's, on your individual, you need to add your own individual preferences on top of it. Let's say the market might be saying we are on InvestCon 4. But if you're looking at it saying, I got a lot of cash available with me, my time horizon in next 40 years, I think I can still keep little aggressive holdings. So again, do not follow Howard Marks blindly. You have to add your own flavor of how does this apply to you. So think about it and see where do you think you want to structure your portfolio. And responses. What are you doing with your portfolio right now? Are you building for InvestCon 4? Or you don't even or you're not even on InvestCon band yet. You're saying, I'm continue to buy it. All the aggressive long tail stocks, tech stocks, which probably not performing right now, but look, VC kind of a stocks. Where are you guys? How many of you are on, let's say, InvestCon 3? 3 says is number 5. How many of you are in InvestCon 3? Saying, we are up 10%. Last 2 years, we were up like 24%, 26%, made 10%. I think I made enough money. I'm gonna eliminate my holdings. Move to cash. I know during April, some investor moved to cash. That volatility was too much. Okay, I got a couple of responses saying, hey, we are on InvestCon number 5. Yeah. Me too. I'm not selling my holdings. I think I'm between 5 and 4 because I'm not selling my aggressive holdings because, I can sell calls instead of selling the holdings, but it is equivalent to selling some deltas. So I'm on between 5 and 4, increasing more dividend paying ETFs in my portfolio, more cash flow rich companies, and reducing deltas on my AI theme based companies, right? So I'm on between 4 and 5. I don't think I will, unless there is a nuclear holocaust, there is a nuclear war happening, then the portfolio will be the least thing to worry about. So I don't think I will ever go into 2 and 1 anyway, but probably right now I'm more towards 5, but even on my aggressive one, I've been selling calls and reducing my deltas. So I thought we look at this then I thought, market generally talks, if we go listen to CNBC or Bloomberg or anyone else, like, oh, there are so many, markets is overpriced, overvalued because the PE ratio is so high, or because the Shiller PE is so high, or because this indicator is so high. So I thought, why not spend some time and look at all the different indicators that people generally throw around and maybe create a list, right? So I went and spent some time looking at different indicators. So by the way, this is how the market emotions always happen. This chart probably I've shared like multiple times, right? Right now I think we are at optimism to excitement. I don't think we are still at euphoria. We are maybe excitement phase, but these things will come. The chart is there for a reason, because we have seen this happening after decades. The reasons will be different, but we always go through this. Everyone I want to all in, that's when everyone wants to talk about the stocks. This is where the typical proverbial shoe shine guy giving you stock tips, right? And this is get me out, which is the depression when nobody wants to talk. Maybe we were in this phase when on 2022, I think we had hardly 15 people in this meeting. No one wanted to talk about any stocks, right? And now we're back to like 50, 60 people joining in, because there is optimism in the market. And this cycle repeats every time. Right? So I thought, let's look for some combination of overvaluation. And then I figured out how can I get those values. And again, you follow whatever works for you. This is just that I was sick and tired of hearing about one or the other indicator. I thought, let me create all the things together, right? So one is looking at the valuation matrix. These are just the numbers. PE ratio is super high, right? So let's look at this. Close to 30, like going back to 1880s. Is it at high? Yeah, it's been higher in 2021, November. That was euphoria. Then we had it in 2008, 2009, and then briefly during the in run up to the .com bubble, right? Prior to that, he wasn't, this is like the fourth largest, highest PE, right? Look at the next one. Forward, because PE, you could say it's a backward looking indicator. Let's look at a forward looking indicator, right? Doesn't look that bad. Right? Look at the next one, which is Shiller P, which also look at the inflation, impact of inflation. Where some of the prices are set going because inflation is high. So it looks to be the very publicious territory, right? The Shiller PE was higher than where it is today only during the .com, just before the .com crash. Again, I'm not subscribing to any one of these, but I just want to give you all the indicators, so that you can make an informed decision. This is Buffett indicator, which is market cap to GDP. So right now sitting at 217%, which is 68.8. It's like 2.2 standard deviations above the historical line, which is huge. But we've been there in 2021, and then markets are still higher than where it was in 2021. But this seems that, oh my God, markets are very overvalued from Buffett indicator perspective. And then lastly, looking at people also look at price to sales ratio. That also seems to be super high. Looking at investor behavior and sentiment, high IPO activity, hot IPOs. Right? When there's a free money, that's why I don't invest in IPO, because a company will come IPO when they know the people are gonna blindly put money in that, right? And pump up the prices. We saw in 2021, we had more than 1,000 IPOs, which is the way, I mean, that was the highest one over the last 25 years. Right? From that perspective, not yet. Not many issuers, we are almost like 3/4 of the year. There's still one more quarter to go, but not that publishers from this perspective. Not many companies are still coming out of IPO and say, let's grab it while everyone is blindly putting money. High use of leverage. When looking at look at last 5 years, 10. Okay, I don't have it 10 years. I can't. You have to pay for it. It is maybe closer to where it was in 2021. When you're feeling a lot more optimistic, you're like, yeah, I can borrow money and invest in stocks. I've seen some investors talking about in 2021 that you should take HELOC and invest in the stock market. That really didn't work out well, because in 2022, you might have lost your home if you have taken too much of that. But people do get when people are in optimism mode, you think life is going to be rosy. So you could lever up your portfolio. Right? Low perceived risk, which is what the VIX will tell you. What's the risk? I think I've seen lower risk than this. I don't think this tells us yet. And let me tell you, 2017, 18, and I think this is more of a short-term indicator, because 2017, 18, VIX was in single digits. Okay, I can do maths. It was so difficult trading options and selling premium in 2017, 18. Over the last 4 or 5 years have been great. And that is why suddenly you see a lot of newbie option premium sellers on Twitter, because they haven't traded in when the VIX was single digits. But I was around at that time. AAIA bull and bear stuff, this is generally a contrarian indicator. You could also add this fear and greed index. And what I look at as fear and greed index every week, you could add that to it, that when everyone is moved into the greedy or extreme greedy, that does tell us little euphoric, and market might be poised for a little more correction in short term. Again, these are all short-term indicators, right? And then we looked at Barclays equity euphoria indicator. I couldn't find a website that does it, but there was a Bloomberg article that I could find. It says euphoria indicator is back to middle digits. It does it. So they look at in some derivatives positions also, and says maybe it is getting little frothy. Look at little about market dynamics, put call ratio. Someone talked about put call ratio. Does it tell us anything? So put call ratio basically tells us how many puts versus calls have been bought. Right now, the need for insurance is not that much. When you won't buy insurance, when you think everything's going to be rosy, right? There is I don't see any clouds on the sky. So why do I need to buy flood insurance? You think the life in the market is going to be all good. So that might tell you something about it. S&P advanced decline lines. So this one, the way to interpret is, it compares the price of S&P index and cumulative number of advancing minus declining. Right? A bearish divergence, which means S&P going higher, but advanced decline is not going higher. it means very few stocks are pushing S&P higher, but the underlying underbelly of the economy or the stock is not that great. And some part of the time it will correct. So let's look at S&P 500 advanced decline line. This doesn't show. If I click on it, will it? Okay, yeah, it expanded. Yeah, this doesn't show that we are, it's more bubbly and being, it's like all the stocks that have advanced. So the good divergence on the market. Concentration, the story stocks. Okay. So I'll just look at a ARKK ETF as story stock. And last one, for me, Vachumath, the king of SPAC, now is back in the market to launch a new SPAC. Because, hey, there's a lot of liquidity. Why not I'm going to do a SPAC, another SPAC? And if you go back and look at some of the SPACs, I think except SoFi, none worked for him. The other SPACs are down like 60%, 80%, 90% over the past 5 years. Now Chamath is back with his new SPAC. I think this is, of all the indicators, this may be the biggest indicator that there is too much optimism in the market that the con man, I shouldn't call him con man, because at the end of the day, you have to do your own due diligence. So don't blame Chamath. It's a free market. As long as he's doing it legally, I think he has a right to take your money because you're not careful about your money. So, and a lot of people come in con artist because that's just a way to shift blame from yourself to Chamath because you lost money in Chamath SPAC. I lost money in Chamath SPAC, but then I was stupid. Right? It's not Chamath. I was stupid. I did not know what I was getting into. That's okay. You learned your lessons. So that's a lot of indicators around. Now, next thing I'll do is maybe figure out a better way to organize it. Try to maybe collect all in one place, and to keep an eye. But yeah, I've heard about multiple indicators. I thought maybe I'll consolidate all and share with you guys. Aditya, are you trying to say the number of people meeting is the best indicator if we should buy or sell? I know you are asking in a jest, but very seriously, I would say yes. Or you go to a party, and when the discussion in the party is all about stocks or Bitcoin, that will tell you that there is a lot more euphoria happening. The Bitcoin price is at all-time high. But I've now talked about saying I think it's euphoria because I don't see people talking about it. In 2021, some of my friends who don't even invest in stock market were asking me about Bitcoin or crypto stuff. They're not asking me anymore. Or maybe I should change friend because maybe they got burnt and hence they are not asking. But, maybe I should get into different parties. But I don't, even if I look into, in the general market, the retail investors have not yet talking a lot more about Bitcoin or the crypto. So I don't think that is in euphoric mode yet, even though the price might tell you, oh my God, it's run up so much. But yeah, this could be a little contrarian indicator because now, a lot more retail investors try to get in when you think everyone is making money, maybe I can make some. So yeah, you may think that way, but that doesn't mean that hey, that if you stop attending the meeting, it means the euphoria has gone away from market, right? The reverse may not be true. Neeraj says he has a comment. Hold on, Neeraj. All right, go ahead.
Hey, Vivek, this is a great collection of the links you have put together. Is there any way you can share this or is it available somewhere?
Let me figure out a way to share it. either on the website. I'll put it somewhere.
Okay, thank you.
Okay.
But this is very good job. Thank you.
If there's something else that you guys are using, maybe you can share and add to it. Because I did add a few of my own, which on this one. So anyway,
Thank you, Vivek.
you're welcome. The last one before we go for breakout rooms is looking into a couple of super investor moves. Before there is a comment from Alan. Is Bitcoin the new gold in terms of safe havens? Is gold a dinosaur? How about strategy? Is CEO a con artist too? So you only know the con once people start to lose money. As long as people make money, they think, oh, man, everything is great. And if people start to lose money, then they will blame Michael Saylor and they'll blame SEC. How could they allow this instrument to be trading in the market? And then they will blame their brokerage firm. How could they allow me to buy this, sell this? Okay. Now coming to the question, gold in terms of safe havens, I don't think it has yet become a safe haven because it's still a lot more volatile than what a safe haven would be, but it is inching towards that. If you ask anyone, let's say below 30, I don't think they're buying into gold. Right? But right now, the thesis of Bitcoin is store of value, which is what the gold thesis has been. Right? The thesis has shifted towards that because central banks is going to print money. They're going to devalue the currency. They're going to reduce the value of what you're holding in your banks. So we are looking for something which central banks cannot print out of thin air, or all the, not just this one, but there are a few properties which qualify as a store of value. Right? You can't print it out of thin air, but you can't print, and it should not deteriorate. I mean, you can have in any other metal. But why gold is the one where there's remained as a store of value over the years is you can't create it in a lab just yet. Diamonds you can, right? You can create a lab diamond, which looks exactly like a real diamond, but you can't do that with the gold. Gold doesn't deteriorate. You can leave the gold and, bury it under the ground in your backyard, and 4 generations later, 200 years later, 500 years later, if they dig it out, it is still the same. It hasn't deteriorated, right? That's why some of the other metals would, or other periodic table stuff would. Like, there are things which are more scarce than gold on the periodic table, but then they have a half-life period. They'll deteriorate, right? There are other things is, it has to be well adopted. You found a material which you cannot create in a lab. It doesn't deteriorate, but only 2 or 5 of your friends know about it. Nobody's going to use it as store of value. Right? Things like, as a widespread store of value. This is where some of these antique materials, paintings will come in. Right? Paintings deteriorate, but let's say you have some antique piece. Right? But if it's not widespread, then as a collective, we don't consider a store of value. So Bitcoin, it started as a hobby among few, but you need to have enough adoption of it before you can qualify it as a store of value. So I don't think it has reached that adoption yet. So I'm still waiting to see more and more people start to adopting it so that it can fortify its claim as a store of value. But it is reaching towards that. Why does silver not command the interest of gold historically? If you keep a silver start to become like greenish, etc. I mean, first of all, it start to lose its luster. I don't know what are the other reasons. Or around silver is a lot more available in terms of the availability, in terms of inflation on silver. Gold, we've already dug out so much that if you want to dig a lot more gold out, it's so expensive that we would rather leave it in the ground itself. So the inflation of gold is around 2%. Inflation of gold is not, I mean, we are creating more fiat money than we can create gold. So if we can dig more gold out of earth, you'll bring on a lot more supply, then it will start to lose its value. You can't dig out because it's becoming more and more expensive. Can Bitcoin be replicated? You can. Bitcoin code is open source. You can create and start a new chain. Nobody stops you. You can just use the code, the same code. The question is adoption. You start the new Bitcoin and you tell me and the people in here, we all buy into it. That's like 50 people, 100 people, 1,000 people. Adoption is what's going to make it as a store of value. Gold has been widely adopted across the world for it to be called as a store of value. Right? That's the difference. You may not be able to get the same adoption. It's like telling if Meta open source is code, can I not create a new Facebook? Sure. But you can't get the same number of users. Market is not going to assign you the same value because the network effect. That is the most difficult stuff. And this is what I don't understand when people say, oh, anyone can create a new Bitcoin. Sure. But you can't create the network effect, the adoption effect. So let's look at these super investors moves. I posted 2 on Twitter. One is around fintech. Total amount invested close to $10 billion. The leader is a Latin America company, not a US company, which was surprising. Could be surprising for most people. It's a company called Nubank. Warren Buffett used to have a stake in this. I think they sold it. All the hot stocks among US investor, Hood and SoFi, has got very less allocation. So the top 3 are Nubank, XYZ, which is Block. This was surprising for me, that Block has got the most allocation among fund managers. And we look at it, almost $2 billion in Block, and SoFi and Hood, pretty less. These stocks mostly retail investors owned. This is as of June 30th, right? Then you have a Chime, Hood, for SoFi. Any other stocks that you consider as a fintech and I'm not included in it? Then basically I'll start to include it. Any other fintech stocks that you own? A firm. That's good. Then if you do, Klarna is not public yet, so we can do a firm. AFRM. Anything else? A firm is BNPL Pay anyway. That's it. All right, so let's look at the last one, which is Smart Money New Gem. So this I did just today morning. V and MA, I mean, these are completely different categories than the others. I mean, these are the leaders. Even though they call them as a fintech, but you know what I'm saying. Right? These are like a Mount Rushmore, very stable companies, and all the stuff. But maybe I'll add it. MA, Visa, MasterCard. All right, so this one was, I looked at new conviction in terms of the new positions initiated by the fund managers. So total amount was $37 billion across all the fund managers. And that's just total 3% of their AUM, which was like, this is why it is very difficult, even for the seasoned investors, to go and find new ideas to invest in. Whereas on Twitter, I see some rando guy talking about 10 best ideas to invest in, right? And everyone has some different best idea. That's why you should never go and investing anything based on what you see on Twitter. If people have a a lot of great ideas to invest in. Whereas if you look at seasoned 90 fund managers, they only invested in like put their capital, which now amounts to only 3% of their total asset under manager. They just want to stay with what's been working for them, and you just can't find every quarter something great to invest in and put a lot of money. You always build your positions. So I looked at data in two ways. One is from a width perspective. How many fund managers have invested in this company? So Chime, I'm not surprised because this was a new IPO. So 7 fund managers took a new positions in Chime. 6 added a new positions in NVIDIA. Probably they've been tired by their investors calling up and saying, why am I underperforming? Why don't I have NVIDIA in my fund? Right. And then 5 did in UNH. One of them is Warren Buffett. Right? Initiated a new position, but 5 of them initiated a new position in UNH. Maybe they think it's a value buy. They understand the sector, this company a lot more than I do. But then I also looked at it. How about the amount of dollars invested in it? Right? Yeah. How does it matter if in time each of the fund manager have got put in very little amount? That doesn't tell me anything about a conviction. So you got to so UNH is on the number 1, $2.2 billion. Surprisingly, there few more came up. Amazon is a number 2 with $1.2 billion of new position initiated, and Oracle is a number 3, 2 funds. So I started to dig deeper. Which are these 2 funds which are pushing these 2 higher? So on Amazon, you can ignore what Francois Roshan has to say because that's very small amount. But Bill Ackman, we looked at its Uber thesis. So this Q2, he initiated a new position in Amazon, which was 1.277, almost $1.27 billion. Right? So if you want to invest in Amazon, maybe you should go read what Bill has to say about it. I'm going to post it because I already read the shareholder letter from Pershing Square. But then you should read because he had initiated a new position, which is generally not easy for a fund manager. And he's generally a more concentrated investor, probably will do a lot more in-depth study than Francois Roshan would have done it. So go and read what his thesis would be. Right? And then when I look at Oracle, it's kind of a Cotu and SEGE. And maybe you want to read what Cotu had to say about Oracle, because they have started a new position. And when you start a new position, you have to do a lot more homework. Right? Then what you're in an existing position or adding to it because, hey, I've already know this company, but building a new thesis is always difficult. I always have to spend a lot more time when I start a new position. And that's why it's a very few I add to my stocks. Like last year, maybe 2 tickers. And because you have to spend a lot more time to build a new conviction. So that's around the super investor moves. And I think that's all for today that I had on my agenda. Elena, Amazon does not pay dividend. Yes, they never pay dividend. But if you're looking for dividend income, maybe you should invest in SCHD without taking an individual risk. That's an ETF that I like because it holds a lot of decent dividend paying companies. But Amazon does not because they want, and I don't blame them. Dividend is a double taxation. I don't want my companies to pay dividend. Because when you pay dividend as a company, you give you are taxed. Then as a recipient of a dividend, I am taxed. It's a double taxation. I would rather have Amazon buy back the stocks. But if they find much better use of the capital, which I think they are, they continue to invest in business, I would rather say, yeah, let's do it. continue to invest in business. Amazon stock is not appreciating much at the moment. Possible. Year to date may not have done much, but I don't invest in looking at what's going to do this year. So yeah, only 4% year to date. Right. That too, I guess it was helped a little bit on Friday. But yeah, I'm not in this just for a year. So when I think about investing in, if you're looking at these businesses or fundamentals, your thesis has to be at much longer term. Mine is at least I'll give 10 years. My plan is that I don't have to sell Amazon forever. If the business continued to perform, just pass it on to my heirs, right? It's so difficult to building a business. Why I would want my heirs to, start digging or plowing the field again when I've already plowed the field, I fertilize the soil, I sown the seeds, and I just want the tree to grow. No, I just want to make sure that if the business start to deteriorate, or if they get into the stuff that I don't understand, yeah, I'll sell the positions. All right, what else? Let me open the breakout rooms, and then we can talk. You can talk a lot more about other stuff. Where are the breakout rooms? So we have a swing trader, day trader, fundamentals, options, noob investor, alternatives, crypto. Alternatives mean crypto, real estate, private equity, private credit, whatever you want to talk about. So go and find the investors / traders of your tribe and knock yourself out in those breakout rooms. Like I don't do day trading, so I won't be able to help you, but someone else maybe. Over the past few weeks, maybe now it's been what, 2-3 months since we started these breakout rooms. I've seen option trading is the most populated one. People want to just talk a lot more on option traders. Okay, let me see if there are other questions. Amazon hosting Bedrock LMS no more. They need a differentiator. LLM could become a commodity. Right now, LLM is very hot. And that's why like people are even cursing Apple for not investing in LLM. And Amazon doesn't, yeah, they have investment in Anthropic. But I think their model is, the way I look at it, their model is same. I don't care which model works the best as long as I can give access to my customers to that model, right? So they don't have any differentiator. Agreed. But they could provide access to those models at a much cheaper rate. But they have other businesses too. The concern is AWS is not growing as fast as Microsoft is. Azure is growing. Azure is still able to clock in like 30% growth rate, whereas AWS is 17%. But AWS is that's a little more concerning to me. But AWS is at from much higher base. But then they have Zoox. Their advertising business is growing like crazy. They have the satellite business, which now they are like shooting satellites onto space. So there are other businesses which is with Amazon. So I'm not writing them off just yet. Okay. Thank you, Neera. Thanks, Morris. Apple has integrated OpenAI. Friday, there was a news that Apple is looking at Gemini. So I don't even know which place Apple is going, because there was, I know, Elena, earlier Apple had mentioned that they're looking at OpenAI, but I think on Friday, Apple, was it Friday or was it Thursday? There was news that Apple is looking at Gemini. It was Friday. That for Siri, they want to look at Gemini. So we don't know. Maybe Apple wants to hedge their bets as well. So that's why it's so difficult to invest on these news. Tomorrow we might hear that Apple is dumped Gemini. Who knows what could happen? So if you sold your stocks on Google thinking that, oh gosh, Apple is going with Microsoft / OpenAI, that's the only way to invest in OpenAI through Microsoft, that wouldn't have been great. All right, what else we want to talk here? Any other questions? And you should be able to unmute yourself now. There was a comment from Maurice. These overvalue indicators sign for overvaluation of market as a whole. Does it also track for individual stock? Oh, I think those were for market as a whole. And again, I think one indicator will tell you that is overvalued. The other indicator, nah, not so much. So at the end of the day, you have to decide what do you think is an overvalued. And it could be okay to stay in overvalued market. Right? Because market could stay overvalued. Like, how do you feel? Let's go to S&P 500. And hopefully when we were at a .com site, right? We give this example of .com. It was, I don't think I'll have it here, right? You only bring in 20 years data. So let's go to, what we don't know is that, I think I've used this example, right? I'm at here because the market has been growing up from 1994 onwards. It's in like 45 degrees. You don't know how long it stays overvalued. And if your time horizon next 20, 30 years, do you really care right now? You know, even if you had stayed invested at this overvalued .com in last 25 years, you are up 3x, more than 3x, almost 4x. Right? But if you had sold it out and then it become very difficult to get back in, you missed out on all these gains. So I think apart from this indicator, and that is why I told that when you look at Howard Marks, add your own one layer of how does it apply to me, which is what when people come on CNBC, etc., they can't tell you. And that's a mistake we do as an investor. Oh, if he's saying it's overvalued, it means market is overvalued. No, for him, for the type of business that person is in, right? And based on my needs, the business I'm in, my kind of investor I'm in, maybe I'm okay. In some cases, you may not be okay. So that's why it is very difficult to tell whether the stock is overvalued. Probably it's overpriced for me.